Hello and welcome to Options for Value Investors, Chapter 1, The Basics. First of all, what is value investing? Value investing is when we try to buy an asset where the value is higher than the price that we would have to pay. And we would sell that asset when the price exceeds the value. And what are options? Options are a derivative of the stock market. That means that when you trade an option, you are not trading a stock. Instead, you are trading a contract which relates to the price of the stock. Options are a timed wager on the price movement of a stock. It's important to understand both of those. So, what are the elements of an option contract? Firstly, we have to decide which type of option we are going to purchase or sell. We can choose either a call or a put. A call is a contract that gains value when the stock goes up, whereas a put is a contract that benefits when the stocks go down. So, in this example, we have two traders. Trader A buys a call for a particular stock, and Trader B buys a put. Trader B wants the price of the stock to go down, whereas Trader A wants it to go up. Now we need to add the strike price. This is the price at which the contract will pay out. For a call, it will be paid out above this price, and whereas for puts, it will be paid out below the price. So Trader A bought a call at $55, so Trader A's contract will be winning if the stock is closed over 55. Likewise, Trader B will be winning if the stock goes under 55. In this scenario, there's no way for both Trader A and Trader B to win their respective contracts. So, expiration is the other major part of an option contract. This is the date on which the contract will end and winnings will be paid out. So Trader A and Trader B have both purchased the same contract, which is going to expire on the 1st of December. Premium is the amount that a contract is paid for. So Trader A has paid $40 for his call, and Trader B has paid $50 for their put. Now, there are two sides to every contract. So, there are now 4 traders in our example. Trader A has bought a call, Trader B bought a put, Trader C has sold a call, and Trader D has sold a put. So these are the 4 different ways that you can interact with an options contract. You can be a buyer or you can be a seller. And if you're a seller, then the mechanics of the contract are reversed. So if you sell a call, you actually want the stock to go down, and if you sell a put, then you want the stock to go up. So what happens if you own an options contract on expiration day? Well, before we go into this, it's important to understand this concept, but you should be aware that for the most part, option traders do not keep their options until expiration. They will buy and sell the contract prior to expiration. We'll discuss this more in a later chapter. So, on expiration day, let's say the stock that these traders are trading options from is under $55 on 1st of December. Then Trader A loses his $40 that he bought the contract for because the contract terms were not met. Likewise, if the stock is over $55 on the 1st of December, then the contract is worthless and the trader loses their money as well. If the opposite is true, and the stock is above $55 on the 1st of December, then the contract can be exercised, which means you will exercise the terms of the contract, and Trader A will purchase 100 shares for $55, which they can then keep or they can sell at the current market value. However, they still do not retain their $40 that they purchased the contract for. If the stock is under $55 on the 1st of December, then the contract can be exercised and the trader can sell 100 shares for $55. Note that with most brokers you don't need 100 shares in order to sell them. That's an advanced topic, but it's important to understand that you don't necessarily need the shares in your account to profit from a put. Either way though, you do not retain your $50 stake. That is paid to the seller. So, to expand on this a bit, let's talk about Trader A, who bought a call. Now, on the 1st of December, the expiration date, this stock that we're pretending exists is worth $60. So let's see how that plays out. At first, they bought a contract and they paid $40 for that contract, so their balance is they are down $40. Then on the 1st of December, they bought 100 shares at the strike price of $55, for which they pay the full amount, $5,500. So currently they are $5,500 and $40 down. However, they now own stock that's worth $6,000. They can either choose to keep that if they think the market value of the stock will continue to increase, or they can sell it for an immediate credit of $6,000, resulting in a total profit of $460. From the opposite side, a put example, same thing, he buys the contract at $50, and then on expiration day the stock is worth $50, so he has won his contract, and he can sell 100 shares at the strike price of $55 and collect $5,500, which means he's currently $5,450 in the green. However, he has a short position and he needs to cover that, so he'll need to buy 100 shares at the market value of $50, assuming of course he didn't have 100 shares to sell. So for this he pays $5,000 and his total profit is $450. So very similar outcome for both of these traders. Now, what about the sellers? So in the example where the contract is worthless, this is actually the best case scenario for the sellers. If Trader C had sold that contract for $40, $40 is the absolute maximum that Trader C can make from this trade. Likewise for Trader D, he sold a put at $50. Trader D, the maximum that Trader D can make is $50. So let's go through their profit example for Trader C, or rather in this case a loss example, when the stock is worth more than the contract strike price. So initially the seller sold the contract to the buyer and they received $40. Now at expiration, Trader C is forced to sell 100 shares at the strike price of $55. And remember, these stocks have a market price of $60, so that's a loss of $5 per share. They do receive the full amount for that stock, which is $5,500, and they have a balance of $55.40. But then they do have to buy those shares at the market value of $60, which means they're paying $6,000 and they are ultimately down $460. And you may notice that this is the opposite of the Trader A scenario, and that is because options are a zero-sum game. For every winner, there has to be an equal and opposite loser. So, Trader D, same deal. They sold a contract at $50, but then on expiration day, the stock is worth $50, so they have to buy 100 shares at the strike price of $55, and then they have to sell the shares at the market value of $50 for a net loss of $5 per share. So let's look at these four together. The trader A and trader B both bought contracts, and they have an initial outlay of $40 and $50 respectively, whereas trader C and trader D received $40 and $50 respectively. If this stock was $50 on December 1st, then trader A loses his initial stake because he bought a call. Trader B makes $450 because he bought a put. Trader C keeps the $40 premium, and trader D loses $450. Now, if the stock is at $60, then trader A, who bought the call, makes $460, whereas trader B loses the $40. Now, trader C loses $460 because they were the one that sold the call, and trader D keeps the $50 because they sold the put. Now, if you're wondering, the risk to reward, which is the risk is how much money you are potentially going to lose, and the reward is how much you eventually gain. So trader A invested $40 and made 11.5 times back on his investment. Trader B invested $50 and made 9 times back on their investment. Trader C made $40 to begin with, but then lost $460. So they lost 11.5 times what they stood to receive, and trader D lost 9 times their initial gain. So these numbers, it should be said, are not realistic. These are not the kind of returns you can expect, but they do make explaining everything a bit simpler. Now, it should be said that stocks don't only move $5 at a time. They can move, in theory, anywhere from 0 to infinity. A stock can't be worth less than 0, but there's no theoretical cap to how much a stock could be worth. So trader A, who bought the call, if that stock is at a theoretical infinite amount, then they will make an infinite number of dollars. Trader B is not quite so lucky. The most that trader B can make is $5,500, which is basically they are selling stock at $55 each, and then they do not, that stock has no value. So basically they're selling something that has no value for $55, which is a pretty good deal. Now, trader C and trader D are on the other side of this deal, and trader C loses an infinite amount of money, and trader D loses $5,500. So trader D's worst case is actually a 110x loss, which is going to hurt. So why would anyone sell options? They must be bananas, correct? Yes, if you sell options, you are quite crazy. So read on, and I'm going to tell you why you should do it. Now, imagine these scenarios again, except you already own the stock, or you really want to buy the stock. So, let's say in these scenarios, you decided, you've calculated the value of the company, and you have realized that the stock is undervalued compared to the value of the company, and you want to buy in. You can buy shares, and I recommend you do, and you can sell shares when you think the price is significantly in excess of what the value is. However, we can use selling options to increase our returns while we wait for the stock price to increase. So let's look at the trader D put seller example again, and imagine that trader D really wanted to buy this stock at $55. Now, when they sold that contract, they made $50, and they bought 100 shares of that particular stock at $55. It's important to note that they probably would have purchased it at $55 anyway, so they haven't actually lost anything, and they made $50 in the process. So they got their stock at a slight discount. Now let's say trader C, who already owns the stock, he buys their shares at a market value of $50, and then he sells a contract against those shares, which gives him a slight discount. Now, in the future, when the stock is worth more and he's forced to sell at 55, now he is selling at 5,500, and that's probably the price he would have sold at anyway. So instead of making just $500, he ends up making $540. And there's actually a much more realistic example, which is that they buy the shares at a low market value and they sell contracts once a month, once a week, however often they want to do it. And they can build up a significant amount of revenue over time until the stock reaches their desired strike price. In this contrived example, the trader C made an extra $200 or 3.6% versus buying and holding the shares. That's it for this chapter. I appreciate that you don't currently have the ability to go and sell options, and I would ask that you please don't until you've watched the follow-up chapters. But hopefully this will be a great foundation for us to move on to some other topics involved in option selling and options for value investors. Thank you.